First rates, Thursday morning. 1:3 is the advanced decline ratio, which is not a very formidable one. Britannia, JSW Steel, Asian Paints, SBI Life. That's the sum total of stocks which are off to a good start. Let me now just give me a second. I'll try and see if I can see some stocks where the volume action is trending up right up there. So Suzlon trending up on volumes, but on the trending down on higher volumes. Piramal, the block deal clearly has been done. The stock is up 1% after that. Yes Bank, Dish TV, Brightcom, the entire penny stock I think is now really flying across. ET now impact, while Bombay Dyeing, guess what, 2% higher already. 2% higher for Bombay Dyeing. It is trending up on volumes which are extraordinary higher. 1.9 million shares first thing this Thursday morning for a stock like Bombay Dyeing. Punjab National Bank, downward bias. You've got State Bank of India, which is not going anywhere. Indiabul Housing Finance just up there. And smaller banks, after what happened with IDFC, RBL moved up yesterday and DCB Bank is moving up today. So it's a good start, but if you really have to identify the real star, and I think it's Bombay Dyeing, 3% higher for Bombay Dyeing. Look at the stock, look at the volume. I think for me, that really is the start.
Yeah, Bombay Dyeing has gapped up about almost 4%. Look at what's happening within the rest of the pack as well. And before anything else, I just want to revisit what HDFC Bank is doing and whether or not you're seeing any follow-through selling after the Q1 update. Still mild actually for HDFC Bank. 1669 is where that stock is. What about Eicher Motors? Has the selling resumed over there after the competition in this particular segment from both Hero MotoCorp along with Harley and then Bajaj Auto as well? Eicher Motors still reeling under pressure, 1.5% lower as we speak right now for Eicher. Bajaj and Hero are the other two stocks which will just come off you on your screens. And remember, yesterday there was Motherson as well, which held out with its stake buy into this Japanese company, which is now into sunroofs. So Samvardhana Motherson mildly in the green, but 90.40. So the headline number is not looking bad after that 6.5% move on the stock yesterday. Let's talk about all the other buzzers from today and tell you what they are currently up to. Look at Tata Power. Remember, they've received that order worth about 1744 crore rupees. They're going to be implementing smart metering project in the state of Chhattisgarh. There's Adani Wilmar as well, which has clocked double-digit volume growth of 25% on a year-on-year basis. Adani Wilmar gaps up about almost 1% or so. KEC International, bulk of new orders equating to over 1,000 crore rupees. Look out for that as well. And then Marico on the downside, wherein the consolidated revenue has declined now in low single digits. So that's the other stock which is in focus and currently lower by about almost 1% as we speak right now. There is also news coming in on Ujjivan SFB. The Q1 numbers are looking extremely fantastic. The Q1 disbursals have come in higher by 22%. Deposits have risen 44.5%. This Prestige Estates as well, which is now in a joint venture to develop IT Park on a 6.5 acre land in Chennai. So that's another stock which is in focus. And then Biocon as well, which has completed the integration of Viatris biosimilar business in over 70 emerging market countries now. So that's the other one in focus. And what about JSW Steel? They're looking to replace HDFC now in Sensex from July 13th. It is on expected lines, but definitely you will see some fund flows getting adjusted there. JSW Steel 794 is where the stock is right now. But Kunal, consolidation for the Nifty, absolutely flat. Any individual stocks that you look that are looking attractive to trade?
Yeah, consolidation I think should be healthy for the markets because you would probably see a lot of churn within the sector as well as amongst a lot of stocks within their respective sectors. One of the stock which I would believe has reached some sort of an overbought territory would be Maruti. We initiated the buy I think at 9,400 for 50 mark. So I think now at 10,000 levels approximately, it's a good time to try and book out profits over here and then wait for retracement as well as correction to buy back again, maybe closer to 9750 mark, 9800 levels.
Okay, let's find out what Naresh's take is on the markets. Naresh, just about holding on to the 19,400 mark by the skin of our teeth. What's the outlook in terms of the first trade that you're punching in?
So the markets still look into getting into a consolidation, time to be stock specific and still a little more conservative. Looking at a fresh breakout in ICICI Bank, the stock is in touching distance of that 960 mark, which was the previous high. sustaining about 960 could be a quick move here towards 1050 level. So a buy on ICICI Bank, keeping a stop loss at 940.
All right, Sanjeev Prasad joins us from Kotak Institutional Equities. Let's connect with him to understand what he makes of the current market. Sanjeev, good morning. Thank you for joining us. Sanjeev, it's been a very good summer 2023. And now the India positioning in last 1 year has changed completely. There seems to be a FOMO by FIs, and there seems to be a lot of excitement among HNI as well as domestic investors. Do you think this market rally will last given the liquidity conditions are so benign, or it's now time to really get cautious?
Yeah, I don't know, if it will last or not last. I'm not in the business of forecasting, where the market will go. All I can say is that if I look at current valuations and compare that with, let's say, 3-4 years back or recent history, most stocks are trading at pretty much the upper band of their historical trading range. In most cases, they are at a premium to, let's say, where they were trading before COVID. And that's a bit surprising because obviously interest rates have gone up globally at the same time, and you are also seeing a lot of risk emerging across sectors. So in a way, on a more fundamental basis, there is not a lot of margin of safety in most of the stocks on a bottom-up basis. The mood of the market is obviously very, very positive. Market will do what it wants to do. There is obviously a lot of selecting, selective passing of data, in the sense anything remotely positive is taken as a big positive. Most of the negatives seem to be getting ignored. So if you look at, for example, some of the auto consumption names, last 4 years volume growth has been absolutely disastrous for autos, and fairly tepid in case of consumers. But as of now, the market is more focused on the improvement in profitability, which is happening on the back of correction raw material prices. So that's what the market likes. You can't fight it, right? So that's where we are. As I said, valuations are expensive. So the chances that you will make a lot of money from here on a somewhat longer term basis gets, obviously lower.
When you say valuations are expensive, what is the criteria here? And given that the market conditions in last 5 years were very different than what they currently are in terms of interest rates, in terms of the COVID impact, would it be fair to compare past with present?
No, I'm comparing it to where they were 5 years back. So 5 years back, you had a very normal environment, right? Let's say compare valuation with March 19. Across the board, valuations are, higher compared to where they were in March 19. March 19, if you look at the RBI policy rate was 6.5%. Currently, also it's 6.5%. If you look at global interest rates, in most of developed markets, interest rates were zero. Now interest rates are significantly higher. So at least on a cost of equity argument, multiples should be logically be lower, but they're higher. So but that's where they are. Second point is, if you look across sectors, clearly the operating environment is a lot different from where we were 5 years back. In many cases, you're seeing a lot more competition coming in, which will play out in the next 2 to 4 year time frame. Whether it is two-wheelers, whether it is four-wheelers, whether it is consumer staples, consumer discretionary. Across the board, you're going to see rapid change in market structure, a lot of disruption coming in. Clearly, that is not in anybody's radar as of now. It's not getting factored in anywhere for now. So given a combination of higher global interest rates, in, let's say pre-COVID now, plus more disruption that's coming in, logically you should be factoring in a much higher cost of capital, which means a lower multiple. So that's more on a fundamental basis, but anyway, this market is bereft of fundamentals now. So no point having to debate on all these things.
What's your observation when it comes to the rural macros right now? And is there any merit in looking at those names with stark underperformance? And I'm talking about the market sectors right now in stocks. Stark underperformance, the parameters weren't quite changing. If I look at the latest Q1 commentary, for instance, coming in from Marico, or the last quarter numbers from Dabur, they all seem to be indicating, a bit of underperformance. But do you expect the tide to change anytime soon? And is that the segment of the economy that one should bet on right now, because there could be higher alpha generation there?
See, we have been hoping for recovery in the rural economy for the last 2 quarters, and expecting there would be some recovery in June quarter. But even the June quarter is looking fairly weak from whatever we have gathered speaking to the companies. And many of the companies already given their first quarter updates, and clearly most of them are signaling continued weak rural demand. And so it's obvious that you're not seeing job recovery the way we had anticipated. Let's say 2 quarters back, urban recovery has happened a lot faster, whereas rural recovery is still struggling. And if you look at the Marico data in terms of number of people who are looking for jobs under the Marico program of the government, which means people have still not gone back to the pre-COVID jobs. Unfortunately, the May 23 number seems to be higher than what used to be before COVID. If you compare May 19 and May 23 numbers, that is number of people looking for jobs in Marico, the numbers are actually higher for May 23, which is a bit of a dampener, I would say, which means that the rural job recovery hasn't really happened to the full extent. But we are hoping that as things normalize in rural India, people start going back to the pre-COVID jobs, and obviously the normal job is much higher paying compared to Narega job. Also, it's a full-time job compared to part-time job under Narega. Incomes will rise, and that will drive consumption. Having said that, the narrative has been talked about. It's already there in the stock prices. If you look at the valuations of most of the consumer staples, already seem to be discounting some recovery in volumes from the rural side. But another 1 or 2 quarters goes by, you don't see much of recovery, then I think the market could start getting a bit worried. But as of now, my expectation is things will start improving, obviously subject to a normal monsoon for the season.
Sure. Sanjay, the other place, where there is big disruption and in just the last few days has been autos, right? Be it Maruti's entry into the MPV segment with its Invicto launch yesterday, or for that matter, the Hero Harley combine, or Bajaj Pulsar now, or Triumph rather. Wanted to understand, what is it that you're making of this changing face of the auto segment, and especially two-wheelers?
Well, I guess, if you look at the profitability of the two-wheeler sector, that is very, very high. Look at, the ROC or cash return on cost on cash investment for any of the two-wheeler companies, it's well north of, 40%. In some cases, as high as 90%. So if you have that high levels of, profitability and returns, obviously that's going to attract more competition. So specifically in the case of the premium two-wheeler segment, iShare is making very high profitability. It was a dominant player. It's the only player for all practical purposes, almost 90% market share in the more than 250cc segment. Obviously, that's going to attract competition. So the question is now, what happens? How does iShare respond in terms of either more aggressive defense of its market share through price action or whatever it may be? So the point is, and this is where things are getting a bit bizarre in the market. If you look at the combined change in market cap of Bajaj Auto, Hero, and iShare in the last few days, the overall market cap of the three companies are actually gone up. So Bajaj and Hero has increased, and iShare has come down, which is a bit weird because logically you would assume that if you have a one-player market going to a three-player market, it's not as if the volumes are going to expand, but obviously profitability and returns are going to could potentially get hit. I'm not making a claim that will happen that way, but possibly, for the more probability that it will happen. So logically, you should see some compression in multiples or much bigger compression multiples of iShare. So that will play out depending on how iShare responds. But this is going to repeat across sectors. The market structure is going to change across sectors, and I don't think the market is even remotely factoring any of the negatives which can come from a much different market structure in terms of more players in every segment going forward.
Another example where you see a similar disruption, what's happened, let's say, to telecom because of Jio, or what is going to happen to the two-wheeler because of entry of Bajaj and Hero MotoCorp. Where else do you see this disruption?
For any sector. Name any sector, I can tell you the problems on disruption. Look at consumer staples, for example. That's one of the sectors which has had a very high, mode for the last few decades. But now you're starting to see a lot many brands coming through the D2C channel, that is direct to consumer. You are seeing, the retailing companies like DMart or Reliance launching all private label brands. So over time, gradually they will start taking some mind share, some market share at the expense of the incumbents. So the assumption that the market has and whatever the valuation of pricing in that, whatever happened in the last 10 years will repeat in the next 10 years. That is, you will see high growth and high profitability for an extended period of time. I think that argument seriously needs to be challenged. And I suppose the volume growth will be there. But whether high profitability will sustain or not, I seriously doubt it. Given the change in market structure, the level of disruption you're seeing across sectors, I would be very surprised if profitability holds up in the Indian context, which means you will see a fairly sharp correction in multiples as and when they happen.
So
we have all seen what has happened in telecom sector, right? 10, 12 years back, the moment you had more players coming, the profitability and the returns of the industry just collapsed. And then you had a second, innings when RGO came in with its very aggressive, strategy, and wiped out the competition completely.
So at the current juncture, if you have to talk about the most overrated sector and the most underrated sector, how would you define that?
Auto is clearly most overrated. Underrated, I don't know. It's not as if if you can find value in most of the markets. Maybe financials, I would say. But having said that, it's a high leverage sector. At this point in time, valuations are quite reasonable in the context of where they have traded historically. In most cases, multiples are actually lower than the pre-COVID levels, but the fundamentals are far better of most of the banks and NBFCs. So maybe that's one sector where at least there is some value based on fundamentals.
About the capital goods universe as a whole, the expectation as per the report is that we could see pretty strong execution. But if you could just break it up for us in terms of roads, railways, even the defense companies under the gamut, what is it that you're expecting?
You're talking about the investment cycle?
In terms of earnings growth, investment cycle, etc.
See, these are all very, very different sectors. So I don't know whether I can, put any one number for the segment. But having said that, as of now, the investment part of the economy is doing reasonably well. If you look at the 4-year CAGR for the GFCF, that is gross fixed capital formation, 4Q FY23 versus 4Q FY19, we are looking at it like 6.6% real growth, which is actually quite reasonable. And given the fact that India should logically be emerging as a second, or a third option for global companies, hopefully we'll start seeing more investment as we go forward. That should result in accelerated, revenues for most of the segments on the manufacturing side. On the infrastructure side, the challenge over there is we focus more on the numbers of the central government. So even the central government has increased the expenditure in the FY24 budget. Unfortunately, states seem to have cut spending quite a lot in FY23. We don't get data that frequently, for the states. For whatever we are picking up, the numbers seem fairly big slowdown over there. So on a combined basis between central and state government, I'm not very sure you are going to see a big recovery as far as investment in infrastructure is concerned. See, railways defense will be fine because that is largely driven by the central government, and obviously the government has a big increase in spending over there, so that should be fine. But otherwise, on a broader infrastructure basis, I suspect the expectation may not play out given the slowdown in spending by the states.
Right. Sanjeev, the other thing I wanted to talk about is what is it that you're making of OMCs? Because, this morning itself, there are a couple of brokerages upping their price targets, upgrading these stocks as well. Are they really in a sweet spot?
Frankly, what is the logic on which people are upgrading or downgrading stocks? Currently they are making a lot of extra profits on the marketing side, given the government is allowing them to recover all the under recoveries they had in FY23. So the current levels of marketing margins on auto fuels is obviously very, very high. But whether that will sustain or not sustain, who knows? Crude prices go up, obviously, unlikely looking at the government stance, that they will be allowed to raise prices. And at some point in time, assuming the over recovery, takes care of whatever under recovery was there in FY23, the government will probably ask these companies to cut prices. So I'm not even sure what basis analysts keep on upgrading, downgrading numbers over here. There's no basis even to make some forecast as far as these companies are concerned now. It's a sad situation, but that's the truth.
You know what? We have MK Surana as well joining in right now, Sanjeev, and we'll let you go on that note and maybe ask him whether there is any rationale to why analysts may be upgrading or downgrading these stocks, and especially upgrading
Good luck.
across the board. Pretty much. He'll have answers for that, right? Mr. Surana, hi, good morning. We were just chatting with Sanjeev Prasad, and he doesn't seem to understand the rationale behind why so many upgrades coming in from OMCs, but perhaps you would have a better answer to that. With crude now largely settling around the $75 to a barrel mark, is it really time for OMCs to cut prices? And is there merit in believing that they are now in a sweet spot?
Good morning. First, it's good thing for the country and for the OMCs that the oil prices are benign in spite of some sort of production cuts announced even just yesterday by Saudi and some sort of export restriction by Russia. So that only means that the crude prices being in the range of $70 to $75 is more logical now than what it was earlier. And that augurs well for a country like India, who are major consumer, as well as the OMCs. Now, whether there is a right time to cut the prices or not, when the crude prices were going up, when the prices were not increased, there was definitely a strain on the oil marketing companies, and I think that is logical for them to recover if they had some sort of under recoveries, which they had obviously. So that is they have to recover that part, and then only there is logical for them to consider the reduction in the prices. That's the second part. The third part is that whether the OMC should be rated or which way it is rated. Of course, the analysts are better just to do that. But I believed, and I have said earlier also, that the oil companies are underpriced to compare to what the potential they have. Now, of course, market have got a way of looking at the things, but I think they are in a sweeter spot right now when the crude price is lower and the margins being healthy, and possibility of crude prices remaining benign for some time.
Dayanand Mittal as well from JM Financial joining in on the show right now. Dayanand, hi, good morning. We were just chatting with Mr. Surana, and he says that OMCs are in a sweet spot right now, and clearly their earnings are supernormal right now in terms of profits in the marketing business. Refining environment is stable. It benefits from cheaper Russian crude as well. Is it really the best time for OMCs?
Yeah, good morning. Yeah, I agree with Surana ji that this is a good time for OMCs. One, crude has corrected, plus government is allowing OMCs to recoup last year losses. So that's good to see. However, the challenge is we are entering into an election-heavy phase, and our view on crude is that given OPEC's strong pricing power, with US shale not responding or not rising despite high oil prices. So OPEC has got kind of unlimited pricing power to, if I were to use that word, and that is providing them the cushion to keep crude price at a high level without worrying about alternative fuels. So in election year, our view is a high crude price may not be the right thing for OMCs. So currently they're making good money. But our sense is probably in a month or so, once they recoup last year losses, government will ask them to pass this on to the end consumers to tame down inflation. And in case crude were to spike thereafter, that may pose some concern for OMCs. So yeah, overall, in a good scenario right now, but outlook wise, I would be a bit circumspect given a positive view on crude price.
Then I distinctly remember when Mr. Surana was the chairman of HPCL, they did a buyback. Last week, BPCL has announced a right issue. Now, there are differentiated policies which have been followed by differentiated OMCs, even though they are in the same business. How should one read into this, messaging? One, HPCL did a buyback at a premium because they had cash. BPCL does a right issue, which in a sense, frankly, is against the interest of minority shareholder, if you ask me. Dayanand?
Yeah, so I think the right issue is more to do with OMC's balance sheet having got eroded last year. And remember, this decision was made on 1st Feb and not right now. Right now is just an implementation of that 1st Feb decision. So given the balance sheet of OMCs got eroded last year, and on 1st Feb, government didn't envisage that OMC's financials would improve dramatically over the next 5 months. And hence government is just going ahead with those capital support decision of 30,000 crore. However, on the other hand, also because government is very serious about reducing carbon emissions, and obviously OMCs and the oil and gas sector would be the key sector which will contribute to this, and hence they would have to undertake huge capex for various clean energy projects. So government thought as well this would help and strengthen OMC's balance sheet to undertake those kind of capex over from next 3 to 5, 10-year view.
Mr. Surana, I remember when I met the oil and gas minister in December, his view was that OMCs have really played their role of being good corporate citizens, which is when the country was going through a tough time, they are the ones who really played their role. Is that going to be the basic role of OMCs in the overall scheme of things, public sector undertaking, which is that you are meant to take care of public?
Yes and no, both. Basically, because public sector companies are in a domain, and especially in oil sector where it is a sensitive commodity and it has got the public at large involved, there are sensitivities on that. So we can't say that we cannot be or we will not be the good corporate citizens when it is required. But at the same time, we are also like any other commercial entities, and we need to play the role of any other corporate. So it is a two horses we have to ride together, and that is a very fine balancing which the PSU oil companies have to do. We don't have choice to shut down the outlets if the prices are high or the margins are low. At the same time, we need to ensure that we have got a healthy balance sheet to support our capex, to have our expansion plan, and have a return to the stockholders. So it will be both ways. Means companies will be playing the role of a good corporate citizen whenever it is required. At the same time, they will keep their business interest in mind, and they have been doing it. It is a bit fine balancing, but they have done it.
Fair enough. Dayanand, let me get in your take on, the overall, spectrum, because it seems that the profits seem to be strong for the OMCs. The refining environment is looking stable as well. There are benefits from the cheaper Russian crude as well. This doesn't really seem to be playing out in terms of these OMCs being rewarded. What do you think are some of the concerns right now within the space?
So as just highlighted earlier, the key concern is we are entering into an election phase, and OPEC is very, very clear that they want to support crude at a particular level. Our sense is that level is $75 to $80 per barrel and above. Given the fiscal balance for most of these OPEC countries, particularly Saudi, is around those levels. So in an election period with crude upwards of 75, 80 may pose concerns for OMCs down the line. That's a key concern. Second, this high margin, we all know, is a temporary thing. They'll get back to normal margins once they've recouped last year's losses. So obviously, this is not a sustainable earning that one should be looking at. And it's not that OMCs have not done well. They've gone back to a one-time price to book versus 0.7, 0 points below that they were trading a few months back. So I think they're now at fair valuations. Now, going forward, as earning grows, probably market will then reward accordingly.
Sure. And what would be the overall investment pecking order in terms of OMCs, upstream companies, gas stocks?
So we prefer gas stocks more as a secular story because the penetration of particularly the CGD companies, because the penetration is quite low for CGD business in India. So we like IGL, Gujarat Gas, also MGL, though in that order. Primarily because of secular volume growth story. Also, they have got a reasonably decent pricing power, though not as strong as it was 3 years back, but still CNG is 40-45% cheaper versus petrol and about 30% cheaper versus diesel, which is decent enough for the convergence to continue. So CNG would be a preferred pick. Among oil names, given our view of crude price being high, we particularly prefer upstream companies over OMCs for the moment. We like ONGC, particularly because of reasonably strong dividend yield of 6 to 8% that they can deliver going forward as well. And valuations are quite reasonable at about 4 times earnings.
All right. Thank you so much, Mr. Surana, as well as Dayanand, for joining in and giving us a broader outlook as to what things are looking like within the entire OMC space, as well as when it comes to the stocks in general. Just a quick revisit of the markets, and currently holding out around the 19,400 mark in trade. You've got the broader markets as well, which are continuing to show that pretty strong momentum. So perhaps that 1 week chart of the broader markets will reflect the outperformance as compared to the frontliners. Names like a DCB Bank or even an India Bulls Real Estate, Bombay Burma, NCC, they're all flying high then in today's trading session. Let's move right on then and talk with the management of TI Clean Mobility Private. Kalyan Kumar Paul is now joining in. Thank you so much for taking time out. Given that this is the EV arm of Tube Investments, so I just wanted to understand the outlook overall in terms of the electric platform in the portfolio, as well as in the small CV segment. We are seeing some of the other big OEMs as well working in that foray. So what are your plans regarding this?
I think our plans are to remain in the productive end of the segment. And therefore, we started off with the three-wheelers. And then, we went into electric tractors and then electric heavy commercial vehicles. And now with the small commercial vehicles. So what we are attempting to do is to straddle the entire productive end of the commercial end of the segment. Now, you may ask me why the commercial segment? That's because, the more a person uses the vehicle, I think the greater the benefits of that. And therefore, the TCO benefits, the total cost of ownership benefits, is very compelling for a commercial vehicle use. And therefore, we are in that segment. We incidentally have the first electric heavy commercial vehicle, homologated vehicle. We are the first in India to have that. And currently they are on test trials with customers. These are on fixed routes. And, if you look at the Indian market, the steel, cement, and some of these sectors account for a lot of the heavy commercial segment. Now, having done that, then the last lap of the commercial segment was the small commercial segment. And we just did, an acquisition very recently, which was out in the papers, and we are there. Now, this is in terms of our own growth strategies, which actually said that we have, in our company, what we call as TI1, which is the existing business, what kind of organic growth we can do. TI2 is basically the step outs on which we want to, get accelerated growth. And therefore, the EV, and this has now in TI2, now we have the EV three-wheeler, we have the EV heavy-duty truck, and then we have the EV tractor, and now the EV small commercial vehicle. As I'm talking to you, the EV three-wheeler is out in the market. We have started to make.
Right. Okay, sir. Allow me to come in with a follow-up question. The auto space is a very competitive space, and it's not the first time the incumbents have not moved into the EV three-wheeler market. The auto ecosystem is a unique ecosystem, different distribution, different manufacturing lines. Why would you enter into a space which is brutally competitive?
No, I don't think the way to look at it is slightly differently, because if you look at the segments that we are in and the competitive intensity that currently prevails, there are only one or two players in that. For example, there's nobody in India now with an electric heavy commercial vehicle currently as it is, okay? If you look at the global landscape as well, there are a lot of new incumbents that have actually taken the lead in the EV segment, whether you look at China, you look at other places. So therefore, it is not necessarily that you have to have you have to be an existing incumbent. That's point number one. Point number two is, see, if you look at the three-wheeler segment, there's, just two players now. If you look at the heavy commercial, there's nobody there with an electric truck. Similarly, on the small commercial vehicle, just now Tata has launched their, ACE category electric vehicle. So we believe that the space allows us, to some headway with the growth. And also there are a lot of demand side, supply side work that is going on in the ecosystem that helps the newer incumbents to make a foray in this market. Parallelly, we have a lot of advantages with our ecosystem, our own company ecosystem, be it finance, be it on the supply chain, and those synergies we can pull inside into this vertical. So therefore we are committed, and thus we made an entirely born electric plan.
Right. Okay. My next question is that tube investments, if I look at the history of tube investments, I often call this like Tata Sons or Berkshire Hathaway. They incubate a lot of businesses, they invest in a lot of businesses, right? Small businesses, you make it big. How much commitment are you ready to put for this entire EV business? What would be the total spread? Because, sir, I understand that the EV space globally is very active. But if I look at what, let's say, Tesla is trying to do in the EV commercial space, we are looking at billions of dollars of R&D, futuristic development. There's a lot of capital commitment required.
If you see the success of some of the other companies, I think the success for us will be that we remain reasonably frugal with our investments. We take smaller bets, grow those bets, and then take on larger bets. That's the way that we are doing. Our own cash flows of the parent company is reasonably steady to support our growth. We've also gone into some fundraisers now. The first tranche of that fundraise has already got completed. And therefore, we are on a steady path in terms of putting steady capexes and taking it stage by stage, in terms of looking at how to up your capacities. And therefore, the more we can disrupt the market, with each company is trying its own way, we are also trying our ways. I think we will have a steady state of a growth. Capexes on the first phase, that we have put in now, and we are putting in gradually. We built in the 3 plants. The EV 3-wheeler plant is built up. The heavy-duty truck plant is built now. The tractor plant is going to get ready in a month or so. And the SUV plant, we have sourced the land, and then we are now getting ready to establish the manufacturing facility. And parallelly, a lot of front-end marketing work is getting done. See, this whole game will be won through how one leverages the ecosystem of charging, the ecosystem, of looking at how to drive a software-driven vehicle. What are the kind of metrics that you can do? What customer experience can you do? And how do you keep your cost actually quite frugal? So we are not a believer of great spends. Actually, we think that if we can keep the investment frugal, I think that allows us many advantages, in the current space. And as we grow up, therefore, then we can take up the next phases of growth.
Okay. So when will the first commercial launch of from a unit will happen? 2 years, 3 years?
Which one? Which vertical are you?
I'm talking about the commercial EV, sir. That's the exciting part.
Commercial vehicle on the 55-ton truck trailer. We already have a vehicle. We are producing these vehicles now, and we are in the business of supplying them to select customers, chosen customers, for our tests and proving the concept. That's currently on, and currently vehicles are getting produced. That's one. The EV 3-wheeler space, we have already supplied in the market, and we are slowly ramping up the supplies, looking at how the product is going to perform, and then take the volumes up. As far as the SUV is concerned, it will be a good 1 year before we are able to, get our product offering, have it homologated, and then ready. So we'll be looking at the financial year 24 for that, actually.
Eventually, 2 years, 3 years, is there a thought that you may want to get into PVs and two-wheelers also once you get the technology right?
No.
That's a big
That
no-no.
space is
That's a big
very
no-no,
crowded.
right?
No, that's not something in the near future at all, because we've done the market analysis. The competitive intensity in that area is very high, and therefore we are choosing to remain in these four verticals for the current moment and build up the businesses of Born Electric actually in these four verticals.
Is the size of the four verticals you are in? Can you quantify the market size in India for us? I mean, what is the total market opportunity?
See, each segment has its own way. No, if you look at, from now on, and you take any estimate of EV penetration from the market, it's anywhere, the estimates move anywhere between 15 to 20% on a realistic basis. Now, when you look at that, the size of these markets, it allows you enough headway with the volumes that you can do, actually. And so the aim is to see how you can get far higher levels of adoption. Because what penetration will happen is anybody's guess. But how to increase that penetration will be the job, which again will come through in terms of the compelling offering that you are giving, which offers a saving on operating costs and allows the vehicle to get paid back into between 2 and 3 years, depending on the category that you're talking about. And then, because the life of an electric vehicle is much longer, so once the payback happens under 3 years, then the rest of the period, the saving is accumulating to the customer. And we believe that will drive the penetration at a far larger scale.
All right, appreciate your time. I mean, you live and you learn, and that's what I think. I've learned a lot of things, interesting things about what is happening in the EV space. Good luck, and thank you for joining us, Mr. Paul.
Yeah, thank you so much. Thank you so much.
Well, I didn't realize that, in the EV space, the attempt has moved up to get a commercial vehicle also. I mean, I still remember covering a story on where Tesla said that we are coming with the EV truck, and that in a sense was a disruptive time because it had an impact on the stock price of Bharat Forge and Motherson Sumi. But here, SUVs and electric vehicles have already started. We don't think about it. We always think electric EV means cars.
Yeah.
But the real load which is also getting carried is actually in CVs. Also the small MHVs or the real three-wheelers. I think Atul Auto is trying to do something there. Tube Investments is trying to do something there. We just don't realize it that how EV is now becoming more and more main stage. We don't step out of cities.
Bajaj Auto, no.
Bajaj Auto has a three-wheeler. They've tried something. No, we don't step out of cities to realize that how India is actually moving.
Transforming.
We are getting really fascinated with that green number plate what we see on the road, say that our electric car hai. By the way, it is now, I used a Uber last week and the Uber actually was an EV. It's twice it has happened that
you've got an Uber.
You've got an Uber. It was not by choice. It was by what the algorithm put it up, and it was a nice smooth ride. It was a good it was a cool AC experience. The car had good maneuvering. But imagine EVs now so quiet. So imagine that, we used to always think that EV is something which is going to be like a rich man's toy, a fascination for those folks who want to save the planet. But now it's coming into the mainstream even when it comes to commuting.
I mean, eventually it'll be everything EV unless there is another alternate fuel which takes over.
And, you normally get into some conversations, curious conversations, and the Uber driver was very happy with it. He said, look, I have to service less, my efficiency is high, my car is giving me better mileage.
Initial cost, which is
Initial cost is very high, and the maths worked in his favor. And he said that, also the high-speed charges, charging my battery in 2 hours. That's today. It may come down to 20 minutes. It may come down to 20 minutes. So that's the real disruption.
Yeah, it's already really speeding up.
Yep.
So. All right, let's move right on then from EVs right back to the good old banks and connect then with Nitin Agarwal, who is now joining in, Head of BFSI Research of Motilal Oswal Institutional. Thank you so much for taking time out. Let's just talk about the overall outlook within the financial space, because the key theme at play in FY24 is expected to be NIM and spread compression. How much of that is really playing out? Who do you see as some of the key winners within this environment?
Yeah, sure. So thanks for having me. And this quarter, of course, is going to be important because last few quarters we have been margins moving one way up for the sector. And we think that this trajectory is now set to reverse, and we will begin to see some moderation in margins for the large private banks and some of the select PSBs also. And thereafter, we expect this fall to accentuate in the second quarter, when the repricing will likely be at its peak for many banks, repricing of deposits.
In this environment, Nitin, when right now everybody's fighting for CASA, fight for liability, who do you think will win this war?
So it's going to be remain a tough fight. While if you look at the gap between credit and deposit growth has narrowed already, and we have seen some pickup in deposits and likewise some moderation in credit growth. And the forecast for the year is for a continued moderation on the growth front. But given that the CD ratios for the system is already elevated and there is limited liquidity that banks are now having on their balance sheet. So therefore, to fund the growth, the deposit mobilization is going to be very important, and which is where the large banks are relatively better placed to raise the deposits and fund the growth accordingly. And the mid-sized banks will continue to face some funding cost pressures, and that will have a bearing on the margins that they report.
Every fund house, whether it is a PMS, mutual fund, FI portfolio, they are overweight on financials. Some have 30, some have 35, some even have more than 35% weightage. So the scenario of a benign interest rate, strong margins, decent credit growth, isn't it scenario baked in, which is that markets are factoring in all the good news for next 2 or 3 years for financials now?
I will say maybe to some extent, but the valuations of financials overall, if you look at, are still fair. Like the sector is today making decadal high ROAs and ROEs. And these numbers are only moving in the right direction. If you look at while the growth in earnings is going to see a moderation now, last 3 years, the CAGR growth itself for our banking universe has been close to 50%. And this number we are now forecasting to moderate towards 20 in the coming 2 years. But 20 per se is still not bad from a point wherein the earnings have already matured. And which is why I think in context to now the valuations, wherein private banks are close to their long-term averages, some of them are trading a lot cheaper also. There is still scope for good returns over the 12 to 18 month horizon.
What has been your take on the Bajaj Finance numbers and even the stock price performance for that matter? Does this now give you conviction that it will continue to dominate?
The numbers definitely were quite strong, and the company time and again has displayed a very strong momentum in terms of business growth, and that has clearly reflected in the price movement on the stock. We continue to like the stock, and while the valuations are expensive, but I think given how the performance has been and the growth rates that they are delivering, the valuation premium will sustain for the company.
And HDFC Bank, that's clearly been in the spotlight of late. Of course, there was the big play with respect to the merger. You had the Q1 updates as well coming in. Is the 18 to 20% growth guidance a concern since they haven't been able to do that in Q1?
So I'll say while yes, Q1 was a weaker quarter, even to our preview estimates that we put out, there was some bit of miss on the business growth front. But as an institution, HDFC Bank has a very long-standing track record of execution. So we cannot really judge the performance on the back of one quarter. But yes, markets and everybody will be watchful of how they mobilize deposits from here, because that will be critical to fund the growth. And also retire the borrowings from HDFC Limited. So the merged loan book, which is over 23 lakh crores approximately, they need like huge quantum of deposits, and that this quarter certainly has increased the ask rate for the residual 3 quarters of the year. which is where it will be watchful, but I think execution has been brilliant throughout, and which is where we continue to like the stock, and I think they will likely come close to the market expectations in terms of growth.
Then what about PSU banks? Because we were just chatting earlier on in the show about how some of these PSBs stack up. And, irrespective of the returns that they may have given in the last 1 year or so, or year to date, the price to book is still very, very cheap.
Yes. So, yes, they have been going through a period of re-rating. The performance over the long period, if you look at, has been quite volatile. And last couple of years, things are moving in the right direction. Most PSBs have now come close to 1% in terms of ROA. And we believe while margins, there is limited scope now for that lever to play out, and OPEX will also be slightly elevated because this full year you will be making the wage provisions. This is started on from November, and now you will be making this for the full year, so that will also be a slight drag on the profitability. But credit cost is still going to be in control, so that is wherein some lever is still there with most PSBs, because a net NPA for some of them have already come below 1%. And for the others, the coverage ratios are already very strong, and incrementally, we are not looking at relatively higher slippages versus what we used to. And which is where we think the numbers, the ROAs will continue to hold and probably get better from here marginally. And that will drive further re-rating given where the valuations are for these PSBs.
So if you have to, let's say, make a portfolio which is of overweight financials, but within that you have to make a choice of overweight private banks or overweight PSU banks, where would you be tilting?
See, this question, I'll say, would have been far easier last year, wherein PSBs were coming off from a very low base and the earning growth was very, very strong. Now, if you look this year, we are looking at a earning growth for PSBs of around 25% for FY24. While first quarter, the earning growth that we have put out is 96%. So that shows you the extent of moderation that is going to play out. So from a first quarter number of 96% earning growth, this number, as per our projections in Q4, is going to go down to 8%. So it's like a very, very sharp moderation. But full year numbers, which are more important to assess the valuations, there is not very big difference between how the private banks will move and the PSBs. The gap is just 3-4% in terms of the earnings. And which is where I believe the performance within the best of the ideas will be fairly similar. At the margin, we continue to like private banks though, between the two, because therein the consistency and delivery has been much more, and the valuations also look supportive.
We were debating this yesterday, and I just want your frank view on this SBI market cap and Bajaj Finance market cap. We were debating yesterday that Bajaj Finance market cap is now nearing SBI's market cap. They are both very different. One is a bank, other is NBFC. One has got subsidiaries, other has no subsidiaries. But if I look at the market cap of Bajaj Finance and the profit of SBI and the brand of SBI and the growth of Bajaj Finance, what is right? Will SBI's market cap go higher, or will Bajaj Finance market cap go lower?
So I think Bajaj Finance as an entity has always delivered very strong profitability, and the stock has always traded at a high premium because of the growth rates that they have delivered over the years. SBI, on the other hand, has its own inherent strengths and is one of the best positioned banks within the entire space, as well as certainly within the PSUs. And we are forecasting very healthy ROAs and ROE. Like our ROE projection is close to 17.5% on SBI, and ROAs are going to sustain between 1 to 1.1. And but certainly there is a big gap when it comes to the ROA that you look at between the two entities and the growth also, and that explains the market cap differential wherein Bajaj has come close to SBI now. So I think both the entities from here will do well. We have a positive rating on both the names, but can't really make like a comparison between the two given the differential in the construct between the growth and the profitability.
All right, Nitin, appreciate your time, and always fantastic to have you on ET Now. Let's take a break. When we come back, we'll revisit this news break in Bombay Dyeing. Now, Bombay Dyeing has gone from 80 to 120. Why? There were a lot of land, legacy land. Mill has become a mall. That's the story for Bombay Dyeing. Will that mill become an office or a commercial real estate now? Maybe yes. That's the story we'll talk about when we come back.
Marico, powered by Century Ply Club Prime. रहो बेफिक्र.
टिप चाहिए? पैसा लगाना है? तो सेंचुरी प्लाई क्लब प्राइम पे लगाओ.